Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, February 1st, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
Okay, it was kind of a rough week last week that ended actually on a high note as we closed out January pretty much. We kind of went from bad to worse. On Monday, I think the Dow was down about 1,000 points. And it was almost 5%. I think the NASDAQ itself was off 4.89%, and that's how we started the week. And basically, what was going on was we kind of got that the Federal Reserve's pivot the previous week there, and we started out with some mixed earnings, and again, it's increasing geopolitical tensions between Russia and the Ukraine kind of set off a wave of selling, and people starting to short the market, which took it down pretty hard. In fact, pretty much across the board, we had wiped out all the gains, about half the gains from 2021. We've gone back, in some cases, back to the May and June lows on Monday morning before we kind of bounced back. Okay, then we snapped all the way back, late in the session on Monday. We actually ended up with some small gains. As far as candlesticks go, that was what's called a bullish hammer. That when you sell off like that, and then all of a sudden it looks like you're going to fall out of bed, and then the bulls come in and they take over and they take the thing up, and they actually end up with small gains. Okay, then Tuesday we did a replay of that, and we had another steep sell off, but we reversed course, came back at the close, didn't quite finish positive, however, but it was still. Kind of shaking investors up. The VIX was up over, up in the 30s. A lot of fear out there. And then on Wednesday, we kind of were thinking that after the January FOMC meeting concluded, that we'd have Jerome Powell coming out there and kind of settling the market and telling everybody, hey, don't worry about it. We're going to raise rates, but we're not going to move too fast. Just kind of being a little bit more dovish than he had been the last couple of times he spoke, and we didn't get that. So, he pretty much was saying, we got rate hikes. It's going to be open at every FOMC meeting. If we need them, we're going to, we got to tackle this inflation problem, and it's going to be an open program, depending on the data, and we could end up raising rates at every meeting. It all depends on how the market's going. And that wasn't exactly what the market wanted to hear, so we kind of rolled over again Wednesday afternoon. Not real big losses, but again, it was sold off. And then on Friday we kind of shuffled around a little bit before coming back here and jumping up. We actually ended up for the week last week, which was very surprising. As far as we got some good earnings going out on Friday and Thursday. We got some disappointing results from like General Electric and Boeing and Chevron, Lam Research, Robinhood. But we also had some pockets of strength in like Microsoft and Apple, and Visa was another one. They blew away estimates, and they helped the market stabilize a little bit and kick higher. We had a 5% spike in energy last week. Part of that was due to crude oil prices pushing up near 90. We also had a big spike in natural gas prices. Part of that this cold front that was going into the nor'easter in Boston, which we got hit with. And we have another a big ice and snowstorm coming into the Midwest. I was in Ohio last week. We had about 16 inches of snow, and it was 0 degrees almost every day. And it looks like they're expecting something like that to hit again Wednesday or Thursday. So natural gas prices are up probably 30-40% over the last couple of weeks. And that helped the energy sector. XLE is the ETF for that, move about 5% higher just last week. In fact, it's up around 12-13% for January. So it's had a real nice real nice run here to start the year. On the flip side, also in there we had some buying in technology, so that was higher. Financials moved higher, healthcare, communication services with Facebook and Alphabet moving a little bit higher in there. But we had weakness in the industrials, consumer discretionary, materials, and utilities. They were all red. We had yields rise a little bit after the Fed statement on Wednesday. 10-year Treasury got up as high as 1.87. I think it settled at 1.77%. I think it's somewhere right around that area right now, 1.78, 1.79 today. As I said, crude oil prices were up. That was the sixth straight week that we've seen crude oil prices move higher. We had a jump in the U.S. dollar with the Fed's more hawkish tone. In fact, it was the U.S. dollar hit its highest level since July 2020. It moved up with the gold prices jumped up. That was at its highest level since 2020, coming off a 6-week low, 1786. So anyways, we cut that bid on Monday or on Friday, and then yesterday, we got another big surge in the market. Technically, that was strong. We were very oversold. The MarketEdge S&P short range oscillator had fallen down below 10, which almost always leads to some kind of a bounce. In this case, that was almost as low as we've seen it. Most as oversold since last April 2020. So, a lot going on. Yesterday, we saw the Dow Jones, the S&P 500, and the Philadelphia Semiconductor Index all able to reclaim their 200-day moving average. That's a plus for the market. As far as technicals go, it means that there's still, somewhat of an uptrend in force here. As far as some of our other indicators we watched, we had the momentum index, the MarketEdge momentum index fall to a -4. It's negative now. That shows negative breadth in everything we were doing. The advanced decline line lost 2,600 units last week, despite the market being up. We also had new 52-week lows. They outdid the new highs in all 5 sessions. The AD line of NASDAQ was also lower. It lost 4,000 units. We've had more new lows than new highs in the NASDAQ now for 10 or 11 weeks in a row. It's not something you want to see in a bullish trend. Another sign that the market was oversold. We only had about 22% of stocks above their 50-day moving average, and only about 27% above their 200-day moving average. Those are pretty low numbers. You don't see that very often. On a positive side, we did get the sentiment index up to a positive 0.4 or +4. You're starting to see a little bit more, the excess of bearishness that comes near a market bottom. We want to keep an eye on that. But I think it was let me find the notes here. Okay, it was the American Association of Individual Investors. They showed that bearish sentiment rose to its highest level since 2013. And then the bullishness has been, the retail investors that are bulls, they're still below the historical level of 30%. They were around 25 or 52% 23% last week, and they've been below the bullish, the historical level of 38% for the last 10 weeks. So we're getting levels that we haven't seen for quite a while. The hedge funds I talked about, the National Association of Active Investment Managers, they're down to around 53% invested. We'll start to see that. But, the other good signs technically that we saw, Monday's low held for the major averages. We did see it taken out by some of the secondary averages. By that I mean the transports in the small cap Russell 2000. So that's a negative. We do like to see those, some of those secondary indexes actually lead the market a little bit higher. Well, how about going to the market recap on our homepage there? And when you get to the homepage, just go over to the right-hand side. And you'll get a chart about some of these internal breadth indicators that we're looking at. Go ahead on down here a little bit further. Okay, you can see over here on the left-hand side here, we have the NYSE advanced decline line, and you can see that steady steady decline pretty much all through January. And actually at the NASDAQ, that decline's been going on for several months now, despite, that just shows you again the narrowness of the NASDAQ's, what's been holding it up. Again, it's just been the big cap tech stocks that are overweighted in the NASDAQ, and that's been able to keep the index up despite that graph is showing heavy distribution in the majority of the stocks. Now just below that, you can see the new highs and new lows, and you're seeing the new lows spike up like that. I should have checked, but I think we had on Monday we had 1,755 new lows on the NASDAQ versus 18 new highs. I think we had 792 new lows on the NYSE with 7 new highs. Even with that. On Friday, when we had the big jump in the NASDAQ and NYSE, we were up, a couple. I think NASDAQ was up again 2 or 3%. You still had 1,152 new lows on the NASDAQ. So this is again fairly, it's a narrow group of stocks that are holding this thing up on this rebound. And even on the Dow, it was up. I'm not sure, like 500 or 600 points. You still had 542. New lows, only 10 new highs. So a lot of weakness going on in the market. I think it's something you probably want to be a little bit cautious about here as we're moving into February.
So we've had a pretty powerful bounce off last Monday's lows. Does it look like we've put in a bottom here, or is there more work to be done?
Well, like I said, the technical indicators are still bearish. There's a lot of go ahead and if you want to go to the charts and we can look up the S&P 500. And when you look at these technical indicators, of course they're all going to be slipping into oversold territory. We often talk about go to the charts, Will, and that way we can kind of look at some of these indicators at the bottom of the page a little bit. Okay, and there are just below the chart that you can see the 14-day RSI. In general, when that thing gets below 30, it indicates that it's oversold. It's also a momentum indicator, which means that the market is going down. There's not much oomph behind any kind of move. But when you see the 14-day RSI fall below 40 or say 38 to 40. That pretty much means you're in a downtrend, which obviously we are. I don't think anyone's going to worry about that. We had, like I said, yesterday we did see the Dow Jones and S&P 500 climbing back above the 200-day moving average, which is plus. As far as what we're looking at, can you pull up the Russell 2000? That fell into a bear market on last week, which means the thing was down 20% from its all-time high. And in fact, as of Monday, it had completely wiped out all of the gains from 2021. Now, you can see on this thing that I think it was Thursday, the Russell 2000 actually took out Monday's low, which is a negative. You'd like to see that not happen, despite this little bounce in here. It was way oversold. But again, that took out the low on Monday. You also had the Dow Jones Transportation Index, I believe, take out the low on Monday. So that's a troubling sign. Part of this, when you get a sell-off like this, where you go into a correction on the major averages, after a while, when you start to get these bounces, you're going to see, some short covering, which you obviously got. I mean, if you were short, you've watched the market, the Dow and S&P going down around 10%, and the NASDAQ down around 17%. At some point, you're going to cover, because as you go into a rate rising environment, it's not because the economy is bad. You're going to raise rates because the economy is still strong, and thus and the inflationary items that we look at is something that we need to control. You get inflation usually when there's a lot of demand for what's going on. Now, I did want to say one thing that I want to look at historically. When you go into and this is what we're talking about. Have we had a new bottom? After you get this initial shock in the market, when the Federal Reserve says, "Hey, we're going to start raising rates," just generally you're going to have you will get a correction a lot of times. I think the historical average is you get about a 7 to 8 percent pullback. But then you go through a period of some limited gains after this correction historically. Now, Goldman Sachs, their chief equity strategist, David Kostin, last week said that he expected historically that the S&P 500 over the next 6 months after you begin to raise rates, historically it's up about 5%, in that 6 months following the first rate hike. Now, we're not expecting the first rate hike until March. So don't think that I still want you to be cautious in here and not just jump in and say, okay, we've had 2 or 3 days where the market's up, because we haven't even gotten to the first rate hike. And I will tell you that last week the CME FedWatch tool has gone up. A week ago there was only a 4% chance for the projection that we would have possibly a 0.5% rate hike in March. Well, I think it was either Thursday or Friday. I didn't check it today, but it had gone up to about 12.5%. So it's on the rise. So some people are thinking that we may get a little bit hike. If we get a half point move in March, that's going to the market's going to struggle with that because it's not what they're really expecting at this rate. So until we get into March, I think we probably have some backing and filling to do, maybe a little bit of sideways action. Again, historically, you get this little shock to the system, and then we start to work our way a little bit higher. And like I said, we haven't even got to that rate hike. But there are a few other things that I think you can watch. Like I said, we'll probably may have come in close to a bottom on Monday, when we saw that big sell-off. What you want to see is, first off, we just talked about the internal breadth with the advanced decline line. We're losing 3,000 and 4,000 units a week. You'd like to see, especially on those days when we rally, you'd like to see an improving AD line. Now, there was a couple of days in here where we've had a rally on this since the market's been pulling back, where we still had more declining issues and advancing issues. That's not a sign that you're at a bottom. You want to see that start to improve. Another thing that you want to look at here over the next, say, week or 2 or 3, if we start to sell off and start to roll over again, keep an eye on that Monday low for the S&P and the Dow Jones and even the NASDAQ. You want to make sure that if we get down there, that we hold that level. If we would break that out on the big 3 major averages, that would be a real red flag that maybe we're going to go a little bit further down from there. Also, I want you to keep an eye on the 200-day moving average. Once you break one of these key moving average support or resistance areas, if it was support, now it becomes resistance. We did get some good power on the S&P 500 and the Dow. It came back above the 200. Let's see if we can hold it. This is only the second day. I know a lot of traders, when they look for confirmation in some of these areas when they clear resistance and support, they would like to see it hold for 3 days. So this will be the second day today. Let's see if we can hold it tomorrow. If we don't hold that 200-day moving average, that's another little bit of a red flag that we may have some more backing and filling to go. And finally, look for the small cap 2000, Russell 2000, the Dow Jones Transportation, and even the Philly Semiconductor Index. I always call them our secondary indexes. You want to show signs that they've bottomed. You'd like to see them start to outperform on relative strength. In other words, if you look at some of the ratio indicators, and you want to see the Russell 2000 transports and all actually, if the broader market puts in a 1.5% gain, you'd like to see those indexes actually come up maybe 2%, 2.25% gain, where they're actually getting more buying coming in than the big 3. And when we get those signs, and you watch that on a daily basis, over the next couple of weeks, if we get that type of all those converting together, that's probably a sign that that you could probably be jumping in here and starting to get moving a little bit. But until we get that actual first hike, it's still going to be a little bit iffy. But again, watch for those 3 things, for their 4 things that we just talked about. as signs that, okay, the rest of the market or maybe the hedge funds or the institutional players are starting to go in. What you can do is you can find some of the stocks that you like that have a good fundamental picture. And perhaps maybe as they come back down here, to key support areas or maybe previous lows, you can even go back if they're trading if they've taken out 6 months of gains, go back to see where the lows were on the charts maybe 6-7 months ago. And if it gets down to those levels, you buy a half position. You're not going to catch the bottom, and so you don't want to always just jump right in because you never know what's going to happen. But if you nibble away on something that's down, 35, 45% from something a stock that you liked, you buy a little bit here, goes down a little bit further, you can always add to it, and you've average cost, and you're going to be okay in the longer run. Because again, as we start to raise rates, it's not because the economy's in bad shape right now. It may if they go too fast, but at this stage, I think we'll take February. We'll be a little bit cautious in here, look for things to improve with the internals, and then I think maybe we can get a few more months here where the market starts to bottom out and we start to work our way a little bit higher for 2022.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.